together and brought up for your consideration today.
Right, they haven't nailed, as you will hear, they haven't nailed the premiums exactly, but they closed in on a range. They will explain it to the board. You'll see higher insurance costs here for two reasons. One is we've enhanced our coverages. We went over every nook and cranny of this project site and all its exposure areas, both physical and otherwise. So you'll see enhanced costs because of that. And secondly, the bond market premiums has gone a little crazy here after the storm, Superstorm Sandy. I'll let them explain. There is a resolution here to authorize them to go ahead and bind, but I will turn it over to you, Andrew.
Yep.
And then,
just to dovetail on Dimitri and Bob, that's exactly where we are after the last board meeting, giving you an update on not only the analysis, but some of the ranges that we expected. We now have a further refinement, which you should have now in front of you, as to where we are at this particular moment. And I believe this is a little bit somewhat on the lower side of what we expected, which is good news. And we'd like to go through them with you, time permitting, on some of the high points. This is obviously a property-driven account, so that's really where the money is, a principal amount of the money is being spent. But not to leave anything outside of that, I'm going to turn it over to Ken Colucci, who has been sort of heading up our team, some who are represented here, property and liability, and some not. But let's go, we can go through this.
Andrew, just let me interject before you turn it over. On that, just to focus you on the chart, the current premiums in our operating budget, if you look at the subtotal for our insurance program, it's $1.2 million. The last two items on the list, about $100,000 was added. We enhanced our coverage after the storm. So we added, our program was about $1.1 million, and we added another $100 right after the storm because the storm was eating up a lot of coverage. Then on the right column, you see the comparative of where they expect to wind up. Just to put some perspective on this, the bottom two subtotals are builder's risk, which the builder's risk in the last two items are being absorbed in our capital budget in the building of Pier A, and that's part of the capital expense. And workers' comp, as you guys will explain, I'm sure, is not really your bag on this. It's handled by our workman's state review, and it's ours by that. Okay, with that perspective, go ahead.
Okay, so just also to paint a little picture of where we were at our last meeting, we were talking about what we're seeing in the marketplace. We're seeing anywhere from maybe 5–10% increases on some lines versus 40% increases on other lines, meaning the property line mostly. So that's where we were last 30 days ago. Now, what we've done in the last 30 days have been real aggressive in trying to bring those premiums down, mitigate any increases that carriers are looking to see for you. So what we're looking at now is different than where we were 30 days ago because of the work of the team. So just to start off from the top, the heading is, of course, expected renewal premium as of 6/19. So this is where we are right now. So we have to have all this done, obviously. We've got another 2 weeks. We've got this week. We've got next week. We're going to be negotiating with the carriers even further on the quotes that they put out, as well as potential alternative quotes that we want to put in front of you. So that's still going on as we speak today. But this is where we are right now. The first line of business on top you'll see is the general liability premium. And the good news there is it's the same as it was last year. So that's what we call flat. We didn't see any increase on there. And so we've negotiated really hard with the underwriters to keep that flat. And that's important for several reasons. What we're going to do now is we look to that's going to influence the premiums for the excess premiums above that. So your excess premiums, there's 4 layers. We want to negotiate with the first excess premium, which is a little farther down. You'll see that's the $105,000 premium. So we want to mitigate that down a little bit. That's approximately a 5 to 6% increase. We want to negotiate further to get that down, because what that's going to do, it's going to drive the premiums for the next 3 layers on top of that. So that will give us leverage to tell the underwriters for the carriers that are on your excess program, hey, we didn't get an increase on the carrier below you, so we don't expect you to have any increases. So that's what we're going to be doing in the next few days, next week. Jumping back up to the auto liability policies, you have a few less vehicles than you did last year, so that's all relative. But what we want to do is maintain the same rate, meaning we want to, on average, pay the same amount for auto liability that we were paying last year. So I just have an estimated amount there of $26,000. That's probably going to change. So if you move a little farther down, you've got, like I said, the excess layers. We'll skip over the property and the property inland marine right now. Just looking at the crime, there is a slight increase there. That is a quote. We did receive that quote from your current carrier. We are looking to alternative quotes to put out on the table for your review and to keep the current carrier honest. We want to get alternative quotes. So we're in the process of doing that now. And that's the same with the management and liability policies. There's 2 line items there, and I just wanted to point out to you that the first line item was from November to November, because that's what this policy was originally written. And then the next line item is from November extended to June 30th, which is the $50,000. So really now what we're going to do is we're going to place a policy June 30 to June 30. And we did receive the quote, and that's at $97,946 for an annual premium. And we are seeking alternative quotes for that line of business as well. The last 2 items, some of these flood policies don't renew right now, so we're just going to leave them. We don't really have much to discuss on them because it doesn't renew till next January and later in the year in November. So on the workers' comp policies, we did just receive yesterday what those premiums are going to be, so we put them in here. And so you'll see that it went from 118 to 115 for one of the workers' comp policies, and a separate allocation is actually on top underneath the auto liability policy. It's $31,000 for that allocation for that policy. So those are hard premiums. We just received those yesterday.
We'll go to the property.
Is there any questions before we move
I want you to focus on property, which will in a minute, but and on the property, thanks to Tessa, Gwen, and Kirk, and everybody for kicking in, actually scrubbing the site, locations, every piece of infrastructure to make sure that what you're about to hear now has coverage. But go ahead.
Can I just make one point? All terms remained the same, so there weren't any differences in terms.
Only coverage enhancements.
So we were able to achieve,
Right.
in the last proposal, we had coverage enhancements, and I think that we were able to achieve those that we had presented, so that should be noted. It's not necessarily
Good point.
on this, but
No new carriers, all the same carriers that we
income.
We can renew with the incumbents. We want to get some alternatives as well.
We're not suggesting any change.
No, we're not. No.
It will only get better from here.
Right.
and all of these are admitted carriers. I know most of the names. If you, for example, I don't know RSUI. I'm not sure.
RSU, I believe they're writing this on their admitted paper, but we can confirm that. Everybody else, well, the public officials, yeah, Illinois Union, that's admitted.
SARG.
And the Aspen and the Axis are not admitted. Those are the excess flood policies. And those traditionally are not admitted.
You might want to describe for the group here the difference between admitted and non-admitted carriers, what that means in the claim situation.
Okay. Reagan, my counterpart. So we access the global marketplace. Admitted insurers are regulated by the state of New York. Non-admitted insurers are insurers that we can access, but they're not necessarily regulated by the state of New York. So they don't pay tax into the state of New York. You pay tax on behalf of that. The allowance of a non-admitted carrier is the flexibility around areas that they will write versus some areas that an admitted insurer would not. So in other words, when we're looking for flood coverage, and we need to buy excess flood coverage, it may not be available in the admitted market in the state of New York. So we go to a non-admitted carrier. Lloyd's of London is non-admitted, names that you might have heard or been familiar with. Excuse me. Aspen and Axis, who are on your program, are non-admitted, and they are, and it's really purely to gain capacity, generally in tougher lines of business, like catastrophic lines, flood, wind, earthquake, You'll see it on specialty type coverages. In a lot of cases, will be written on a non-admitted basis. So there's no protection. So unlike guarantee funds or things that the state might impose on an admitted carrier for protection, in a non-admitted carrier there isn't that same protection. So what we do is make sure that the non-admitted carriers we work with are highly rated, have enough surplus to protect us in the event of a loss. From a claims perspective, it's been rumored that they're more difficult to work with and it's more difficult to get money from them. But I have to say that a lot of business that we've had on a non-admitted basis during Superstorm Sandy, their recovery was sort of first and foremost. They figured they were in and we paid. Some of our admitted markets in the state have given us more of a hard time than the non-admitted markets. So it really depends on the circumstances. I think on a liability side, it's more difficult to get money from them. On the property side, it generally speaking has seemed to perform pretty well. So we would, and there's no reason really for your risk to be in a non-admitted market on the liability side. You know, as we've talked about before, we think that it's a likable risk and that there's alternatives out there. We don't have to seek non-admitted. But for things like flood and things that, you are right on, we know. We're a bit exposed on the flood side. So we do have to seek alternative markets for additional capacity.
So where you had carriers that have had major claims in the last year, there are no solvency issues that
there's been absolutely none. No, they're really, while the storm seasons and the oddity of the weather we've had, not just here, but across the country, so most of the carriers we work with are writing national schedules. They still have a lot of money and a lot of capacity. So, yeah, right. And they probably will go through this year unless this season turns to something crazy with making even more money. So I think we'll pass this pressure point of the market reacting the way that it has reacted, and it will seem to soften in the next 12 to 18 months, barring any major storms or even with all the crazy tornadoes and all that activity that's happening in the Midwest. It's really, I think that we're going to weather through it, pardon the pun. So.
Okay, so Ray, you want to take the lead on that? Okay, so since our last meeting, as was discussed, we have done an extensive review of batteries, coverages, and values from expiring. And with the help of Gwen and Kirk, we were able to find that what it resulted in was on the seawall, a 52% increase in values, and on the property policy, a 9% increase in values. Our expectation at last time's meeting was property policy to have a rate increase of 10 to 20%, and the seawall inland marine policy to have a rate increase of 20 to 40%. So this is sort of what we were looking at going into it. That said, we have received your incumbents' quotes, which is Hartford, and we're very pleased with it. They've been able to put on the table for your property policy a flat renewal for rate. So the only increase in premium that you'll see is due to your increase in values, which is not that much. It's I believe expiring was $98,000, and your renewal has come in at $105,000. For the seawall, which is what we're most pleased about and what we were expecting the highest increase from, we've received a 12% increase in rate, which is phenomenal. We were expecting 20%. And again, these are first on the table. We now are beginning the negotiations with your incumbent. So as a start, I think it's pretty clear how Hartford feels about their relationship with Battery Park. Not only that, in their expectation to increase your rate from 20 to 40%, they also came out of the gate saying that they were not willing to offer you your flood coverage, which was originally $5 million. They were willing to maybe offer $3 million. We've been able to negotiate with them to offer you your expiring $5 million flood, which is another major point. So with that 12% rate increase, we're also looking at with your total premium, since you'll see it goes from 406,000 to 694,000, mainly driven by your overall 52% increase in values. So if we were comparing apples to apples, if we had your expiring rate, which was 18 cents, and we took your 52% increase and threw it in there, you'd be looking at a renewal premium of about $612,000. So that said, it's a pretty good renewal, but mainly driven by your increase in values. And that's kind of where we're at right now. We obviously just got these, so we're reviewing them. All terms and conditions are as expiring. So the only thing, once we have a drilled down negotiated quote, would be enhancements and improvements that we would bring to you from what you had last year. But for a starting point, I think it's fantastic and better than we had expected.
Well, I think, just to mention this, Hartford on the inland policy, I mean, we're close to a limits loss due to Sandy, right? So it's it's better than we've been seeing in the marketplace, that, to not have a reduction in capacity and to have an overall flat rate to the extent that we discount the values, and no change in your deductible terms is good. It's excellent, actually. So I do think that there's something to be said about the partnership with Hartford. I think that the claims activity that went on, your responsiveness, your mitigation techniques, things that all of you did to get out in front of it, showed a lot to Hartford about the type of risk that they're insuring. A loss is a loss, but it's really about how you handle the loss once it's happened and the things that you do moving forward to help mitigate that. And I think the reward back was, we are going to give you back the flood coverage. That value in if we would have had to go out on the open market and buy a 3x of 2, would have been incredibly punitive. I mean, we've seen it on our other policies. It could have been $100,000 more in difference or more. So there's a lot of value put behind what they've done. So I think I'm happy with the result. And again, we have the numbers in so we can further tweak and negotiate and make sure all terms are either bettered or obviously stay the same or improve.
Have you gotten any of the quotes from anyone else?
Yeah, I was just going to add that we did approach 15 key markets that we would go to, and we've received declinations across the board. There just is not an appetite right now for this type of exposure for where you're located.
How about one of the non-affiliated companies?
Well, we do have right now an alternative option in the works. We're not sure how it's going to price out, so it's not something we want to present. We're hoping to have it a more solid idea of it when we hopefully come back with our final numbers. There are some alternative markets that are looking at the seawall. There has been no interest in the property across the board for many of the markets, but in the marine, we do have some alternative markets looking at it, and it really would be piecing together a quota share, a bunch of companies sharing. But right now, at this point, what we were really waiting for was your incumbent, because that's going to show us where we have to go in order for it to make sense for you.
If Sandy didn't occur, would the price still go up? I mean, it's because of the
it would have always gone up because of the exposure.
Yeah.
The exposure is 52% additional.
But Sandy has changed the marketplace completely, especially for where you're located at Battery Park. So, and also to look at the seawall, the inland marine renewal number, $694. That's not taking into consideration the values for Pier A, which will be rolled in once the project is completed. We can obviously come up and calculate an idea where it will be based on the rate that you have from Hartford, which right now is a 20-cent rate. It will probably look like $73,000 to $75,000 in additional premium. But again, that's not taking into consideration. It will not be insured for a full year, so it could go anywhere lower than that. But that's something to think about.
The tenants usually have carry insurance, right? Are they putting us on as additional insured, thus bringing our numbers down?
Well, this policy is your inland marine policy. So this is the seawalls, the docks, the piers, the grounds, the parks. It's all your
It's the
infrastructure.
perimeter of the entire property.
The ball field, all of that is what's covered in our inland marine policy.
But in the case of Pure A, the tenant will provide us with the loss insurance, property loss.
No, the agreement is charging.
And the P and the marina, I mean, they don't,
We carry the property insurance on the Pier A, but they will indemnify and hold you harmless and name as additional insured throughout their activity. But the property is actually under BPCA's responsibility.
Yeah.
so we don't require any of our tenants to provide us with the.
Sure, all our leases have baked in insurance requirements and certificates and named and where, and the parks are named insurance.
Now they carry their own property loss.
All the buildings, yes.
We impose requirements on them. So we have a series, they have to have a certain level of commercial, certain level of property and liability coverage.
Are they insuring the entire improvement, or only the improvements that they
They're
made?
ensuring their respective interests in the assets.
So even if no shell, it's not triple net with, we have to insure the shell.
We still have insurance on Pier A, yes, we still have insurance on that structure, as well as the community center.
Both while we're building and after it's built.
That's right.
So we should understand whether we're both insuring the same loss, because that's a redundancy that I would assume we don't have to deal with, right?
Right.
And if it is different
Insuring our
complementary
respective
coverage, fine, but.
And we're insuring our respective interests, and then we just went through this with the community center.
I believe that the tenant would insure for their improvements and betterments, and we insure for the building here. So and we just reviewed that agreement.
Total coverage, but no other.
Yeah.
I have questions as I look at this. I see this year $50,079 with Illinois National for the public officials liability. It says included in above, so you folded that into.
Yeah, those for an extension is consent.
Right, that's been basically folded into, the new premium would be right now from your current carrier is $97,946. $50,000 was an extension from November of last year to June of this year.
To make it concurrent with the.
Oh, okay. And then we have 1, 2, 3, 4 little dashes under 2013 for what amounts to about $110,000 in current year premiums. All 4 of those entries are flood.
Yeah, they're not being included, I think, in the calculation because they're not renewing on June 30th. So we're not really looking at them.
Well, then the subtotal is apples and oranges, is it not?
I mean,
Yes, you're right.
The subtotal is apples and
We
oranges.
could take them out.
Because I got one line item that's going up $288,000 by itself.
That's true.
And
You're
in
right.
the aggregate, I only see a $158,000 aggregate increase. So we got apples and oranges. So the 1209 round numbers is really $1.1 million.
yeah.
On a comparative basis.
We added the bottom 200,000 right after the flood to enhance our already current coverages back in.
But even though the dates are different, what's going to happen when that date arrives? We're going to have to renew that insurance, are we not?
Yeah.
With things that are going on in the market, what would we anticipate the carrier's response would be from a premium perspective, given the recent experience? Where are premiums going on flood insurance around here?
Well, I think that the comment I can make, because we put these together in November of 2012 post Sandy, if we knock wood, work through this, we're in storm season, arguably. Not supposed to be Northeast storm season, but it is. If we work through this year, this season, and we come out clean, then I believe that these numbers are going to go down. I just don't think there'll be as much pressure. We needed to secure higher limits than were available because we knew we had aggregate that would have been eroded, as a result of Sandy. So this is, if you think about timing, last year when we asked the board to approve these, it was a reactionary market. To come up in November, barring any major issues that we would have here in New York, then I would expect that the numbers would go down. It'd just be a natural, and there would be more available market, because another problem we ran into was there was not a lot of available market on a client that had losses pending from Sandy. So there were a whole bunch of factors that I think went in. The other thing that is what we will do come November is we'll move this to June. So we'll work off of either we'll extend the existing or we'll do an 18-month policy on a secondary basis. So that it's all term with June, which we want to have done.
Okay, another question. You talk about this 52% increase in value that impacts, obviously with a rate, the aggregate premium. From when to when did this 52% show up?
So the 50, it's year over year. So we just went.
Our value went up 52% in 1 year.
Well, to be honest, not really. I think we did a very, very extensive Tessa, an incredibly deep dive that I don't believe has ever been done before to that extent. I mean, it was
just named everything basically.
Yeah, everything there was. We had a concern, I think. Together, we had a little bit of a concern if we had a situation happen again, would we have everything throughout the entire property insured and recognized under these policies? And I think we all felt that we should do a deeper dive. Yeah.
Okay, so what that boils down to is that in prior periods we were understating the value and therefore receiving a lower premium, not necessarily by design,
right.
Just been old numbers. Hurricane, flood is a wake-up call.
Yeah.
Wow, we really can't have a casualty. Let's figure out what it would cost us to replace in the real world. And those fresh numbers drove the value that the premium is applied to by about 50%.
Yes.
And if I go back and extract the round numbers, 110,000, that's the apples and oranges, and bring this down to $1,000,001 to 1,367. Apples to apples, I got about a 25% aggregate increase in premium dollars. Now there are categories of coverage in here that don't relate to casualty values, so we can refine it further. But in the aggregate, I understand it. Okay.
Right, it was
You guys
a year
understand what I'm talking about?
descriptive detail. You're correct, Mr. Chairman. Was it near coverage of infrastructure? Was it near as descriptive and detailed as it is now?
What is the difference in TIV?
For the seawall?
From where we were to where
We were at 222 million last year, and we're at 339 million this year.
And that's a significant.
And not only that, it's just the actual description that we've been able to put on the actual
In prior
policy.
years also,
Yeah,
I
it was
believe
like
it
a
was
paragraph.
a
Now
section or sections of the seawall. Now we expanded that
everything
with the
is,
thought that if a casualty happens along the 1.1 mile seawall, it wouldn't be the entirety of the seawall, but maybe 2 or 3 lengths of the seawall. Now we expanded that, so that added to.
And we put a value against
Yeah.
it. So we actually know to the degree that we would have to replace that. What it
Mr.
costs.
Chairman, this was a reflection of your concern and the Vice Chairman's concern last time we talked about insurance right after the flood. So the staff drove it to its conclusion.
But we had $504,000 last year. Last year, expiring June 30th. We had $504,000 cost. That's up to $800,000. So we got a 60% increase in premium, a roughly 50% increase in value to which the rates are applied, and then what's going on in the markets, particularly with the seawall and so on, the kind of damage that is potentially out there. We're paying an increase. And at some point in the future, perceptions may change. Okay, I understand this. Do we have... now there's a couple of other little categories down here that we didn't quite get to, but
Yeah, I think the builder's risk, so we obviously are going to extend that for another 30 days until the project's completed, and then it will roll into the seawall. Also, once we present our final quotes for the renewal, we would like to offer Battery Park some excess options for flood. So we would like to recommend that you have, 10 million total on your property and 15 million on your seawall. We'll give you options for a seawall of 5 million X of your primary 5, and then also 10 million X of your primary 5. So that you'll be able to see pricing. Whether you choose to have that is up to you, but we would like to recommend it to you.
Well, and I just want to make an add-on to that. Our concern is primarily around adding the pier into the existing inland seawall policy. It increases significantly in value, and it's definitely exposed. We know if we were to suffer a storm of the same magnitude as Superstorm Sandy, we would suffer damage. Well, we all believe that we hope that would never happen again, but the likelihood is there. We did suffer a loss there. We also suffered a loss in fall fields, and if we had the same type of storm scenario, who's to say that we wouldn't have the same type of loss? Our current inland policy insures for $5 million in flood. The current builder's risk policy insures for $10 million in flood. When you combine those together and you start increasing our exposures, we don't know that it's prudent just to sit with $5 million in flood, knowing that what we had occurred, if it hadn't been two separate policies, we wouldn't have had enough flood coverage under one. So it's prudent to show you the options in increments of 5 million or however we get there. But coming off of, when we look at something coming off of one policy with higher limits and moving on to another policy that has lower limits, and then you look at it in the aggregate of what could occur, especially now that we have experience based on that from the superstorm, it's prudent for you to consider buying the higher limits at that time. And we can do that on what we call a prorated basis. So when we roll in the pier, we can buy additional flood to expire on the June 30th date to make it concurrent. Stay tuned.
the builder's risk from roughly 50,000 to 12,000, then to be extended 1 month and so on. The $12,000 is what?
I just came up with that. That's basically just an estimate. What I did was I took that $50,000. If you look at the term, what that was for, it was from February 15th of this year to June 30th of this year, which is about 4.5 months.
Oh, I see.
So I just divided it by.
It's just 1 month's cover. It's one month's premium for an additional month's of
I just took a monthly estimate.
I got it. Yeah, it wasn't 12.
It wasn't a full year, right?
Okay.
And we are doing, Mr. Chairman, an operational review with regard to cyber for the agency as well, and more to come on that.
Okay. Does your coverage exclude locations within the 92-acre site?
No.
Okay. Other questions or comments? What do we do? We have a resolution. Do we have action here to take?
Yeah, I guess we're asking the members to proceed and authorize proceeding along these lines to buying the premiums, and we'll report back the final numbers. And again, following that, the option, you're upstairs, you'll be coming down regularly. So we're asking the members for authorization to proceed based on what you've heard on these coverages and authorize paying the premiums.
At the subject of final numbers, and as both the chairman and the vice chairman tasked me many months ago, I'm directly involved with each one of these contracts. So subject to final numbers, which we will bring back to you, authorization to begin entering into these contracts.
Any other comments from the members? Do you have a motion? We have a motion. We have a second. Second. We have a second. Hearing no opposition, approved. Thank you very much.
Thank you, guys.
Post-employment benefits. Where is Harvey?